Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. This is Mishkin Santa here for the Essential Tax Podcast. Today's podcast is, I think, a highly relevant topic. I just got back from an IRS nationwide tax forum, which was really nice this year as compared to prior years. But one of the breakout sessions that I attended was actually on the topic that I'm talking about today, which is the Foreign Account Tax Compliance Act, better known as FATCA. And there's some specialized forms related to the Foreign Account Tax Compliance Act, the Form 8966. And then for the individual listeners, what you're probably going to be concerned about is the Form 8938. Now, today's podcast is a masterclass podcast, meaning it's just me. And I am going to be talking about one tax topic and maybe some forms. So I'm going to try to go in depth on all of that. It is mostly, I would say probably almost 100% international tax based and related, no really domestic U.S. tax that I'll be talking about today. So keep that in mind when you're listening to the podcast. I believe it's highly relevant, though, for those folks that do have international tax compliance and international informational reporting requirements when it comes to the Form 8938. The IRS is doing what we call a matching with Form 8966, which has to be completed by certain foreign financial institutions and certain foreign financial entities. And what happens is that those entities, and we'll go into this, and I'll make sure to attach all the links in the show notes, but those entities and institutions report certain interests, bank accounts, investment accounts, brokerage accounts, interest in foreign corporations, interest in foreign trusts. Basically, they're reporting that information for informational purposes on the Form 8966 to the Internal Revenue Service. And then the Internal Revenue Service is then taking that information and then they're matching it to the Form 8938, which is filed by the individual taxpayer with their 1040 individual tax return. And if there's a mismatch, then you could potentially get an issue that's benign, so it's easy to resolve, all the way up to potentially a $10,000 civil penalty, which if you don't cure that issue, they can assess what are called additional civil penalties of $10,000 per month up to $60,000. So a very interesting area. And without further ado, I'm going to get right into it. So the Foreign Account Tax Compliance Act comes from the HIRE Act, which is way long ago, over a decade ago. Its effective date is March 18th, 2010. And the Form 8938, I remember when that came out, it was just a couple days after my birthday in 2011. And so basically the way for most folks to understand this is that the form is not even available prior to 2011. So 2011 would be the first tax year that you're going to be using the Form 8938. And you're probably thinking, well, if it came out in December 2011, then how is it used for 2011? Well, the 2011 tax return is not filed until 2012. So it actually kind of came out, right before the end of the calendar. Normally, these forms come out and they're in their full fighting form way before the tax season gets started. This one kind of came out at the very last minute in 2011 and then implemented in 2012 for 2011 tax return reporting. Okay, so what is the Foreign Account Tax Compliance Act and why is it in place? Well, prior to the HIRE Act, the United States Treasury Department was estimating that the United States government, was losing about $100 billion annually to offshore tax evasion. At that point in time, we also had Bradley Birkenfeld, who had kind of dropped the dime, if you will, on Swiss banking and all the stuff that was being hidden in Switzerland. Now, the $100 billion, a lot of people have disputed that number. Is it higher? Is it lower? Some people have even said it's almost impossible to really estimate what the amount of the annual offshore tax evasion is costing the United States government. However, as part of the HIRE Act, and this was something that in the HIRE Act, it's a pay for, so it's a revenue raiser. FATCA comes in and basically requires what are called foreign financial institutions, or FFIs, to report foreign financial assets and identities of U.S. account holders. And then in the reverse, U.S. taxpayers, they have to self-report their foreign financial assets and interests on the Form 8938. Okay. So again, that's the kind of overarching, thing that you have to keep in mind when it comes to FATCA, why it was implemented and why it was used. The Internal Revenue Service spent about $574 million to implement FATCA between 2010 and 2020. And the revenue that was supposed to be raised during that time period from FATCA, the estimates put it at about $8.7 billion. That's the target of the revenue that was supposed to raise during that period of time. However, year to date, the total amount of penalties assessed by the IRS and revenue raised specifically from FATCA or directly from FATCA is about $14 million. So it's a really, really shortfall that's going on there. Now, there's some ancillary things that are floating around here because we do have some court cases where they've used FATCA to prosecute and win those prosecutions and obtain revenue. You do have the FBAR litigation, which we'll talk about the FBAR a little bit later. This podcast is not about the FBAR, although I'll do a separate one on the FBAR. We'll talk about how the revenue is raised between there. But there's really a very hard push right now, I think, with the Internal Revenue Service. Now that we're beyond COVID, they don't, they've kind of overcome the hump of the backlog. They've got the push from Congress to go out and go after high net worth individuals. And so this is one of the tools they can use to really squeeze high net worth individuals and assess certain penalties and obtain revenue. So keep that in mind. That's another overarching principle that you have to keep in mind on this. So what does FATCA tell the foreign financial institutions to do? Well, and there are regulations that talk about this, which again, I will post in the show notes. But what a foreign bank, let's say, has to do. So let's assume we have a bank that's in Switzerland, UBS. What they have to do is they have to look for what's called FATCA indicia. Okay, and so what does that mean? What does FATCA indicia mean? It means that they have to take a look at their account holders for each of their bank accounts, investment accounts, brokerage accounts, custodial accounts, which we'll define what those are here a little bit later. And they have to see, okay, is the account holder someone that maybe was born in the U.S., has some form of ID that's U.S. related, maybe a passport or a driver's license? Have they supplied a U.S. mailing address or a U.S. telephone number? Or do they have some kind of instruction on the account to send statements to a U.S. address or a power of attorney that's in the U.S. or in care of or hold mail, those kind of things? So that's what they're looking for, okay? And when they find the indicia, it's their requirement, it's the bank's requirement. And for those people that have foreign bank accounts, they've probably had to deal with this. The bank then sends the individual, hey, we think that you have, some reporting that needs to be done here, at least on our end and maybe on your end. And we need you to kind of verify, are you a U.S. person? You either need to complete the Form W-9, which is completed by U.S. persons, so it's U.S. citizens, green card holders, individuals satisfying the substantial presence test, they'll complete the Form W-9. Or if you're not a U.S. person, then you complete the Form W-8-BEN, which basically means that you are a non-resident alien of the U.S. And for any of my clients that are listening, or folks maybe that are not clients that are listening to this right now and are employees of an international organization inside the United States, or maybe a diplomat on an A1 or A2 visa, diplomatic support, or even, students F1, J1, M1, one of the issues that those folks have is that they do have U.S. indicia, right? They're inside the United States, but because of their visa, for the most part, again, we're talking about A, F, G, J, M visa holders, their days don't count for purposes of the substantial presence test, and therefore they're not U.S. tax residents. So they have this weird kind of, square peg in a round hole, and a lot of the banks probably don't understand it. Someone that works for the World Bank or the United Nations or the IMF, or a diplomat that's, living and residing in DC that's not a U.S. tax resident. And so it's very difficult, I think, for those people, especially, to comply with these requests from the banks and the banks are then trying to comply with the regulations here back in the United States. So you have that issue floating around. But I will say that this issue of looking at an account holder and determining their jurisdiction of tax residency is not solely related to the US anymore. Now we have the Common Reporting Standard, which encompasses a lot of Europe and other countries. And so basically all account holders at pretty much all banks except for US banks. The US doesn't play ball with any of this. There's no reciprocity going the other way, and we're not a signer on CRS, Common Reporting Standard. But pretty much all banks outside of the US basically have to look at their account holders and confirm residence. Okay. And so again, if you look at the regulations when it comes to US indicia, it's a little interesting to read through it. And let me just read you an excerpt of a regulation here, so that people can understand. So it talks about the indicia of the FATCA indicia or the US indicia, right? And then the FFI must document the individual person. And so then it says, for example, if a participating FFI was only required to perform an electronic search with respect to a pre-existing individual account and no US indicia were identified in the results of that search, then the participating FFI would not have reason to know that the individual account holder was a US person, even if the participating FFI had on file, but was not required to and did not review a copy of the individual's passport that indicates the individual was born in the United States. So again, this is basic US indicia searches. It doesn't require exorbitant efforts by the FFI. They're not really required to do, a lot of exterior research on most accounts. And we'll talk a little bit about the parameters here, de minimis to high accounts, and then maybe there's things that they have to do above and beyond that. But that's really the requirements that are going, for the FFIs. Okay, let's go back to FATCA for a second, because I want to explain a couple things and give some more context before we get back in the weeds. First off, the application of FATCA to U.S. individuals living offshore, which we refer to those folks as expatriates, not to be confused with individuals that have given up their green card or given up their U.S. citizenship. We call those either covered or non-covered expatriates, a whole different terminology. What I'm talking about are individuals that are still U.S. taxpayers that are living offshore. Estimates have that FATCA will apply to anywhere between 5.7 million to over 10 million people. There are two types of FATCA agreements. There's agreements that are with IGA countries, and then there's agreements with non-IGA countries. And for the listener in the audience, the best way to understand that is that when the bank gets this information, so let's say they look at a bank account and they look at the taxpayer on the account, and they determine this person does have U.S. indicia and that their information does need to be reported to the Internal Revenue Service. Well, in an IGA country, so that's an intergovernmental agreement country, that information then goes from the foreign bank to the foreign government and then to the IRS. So there's kind of a three-step process that happens there, okay? And I'm not sure about you, but I really don't want my personal information going from my foreign bank to the government of the foreign country to the IRS. But that's the way IGA country modeling works. For non-IGA countries, the information goes directly from the bank to the IRS, okay? So that's basically the two big picture differences between how the information is relayed. I want also folks to keep in mind that one of the reasons why, and we'll talk about this here in a little bit, sometimes, or a lot of times, I've heard my clients say, I've got a bank account with this bank in this country. They're going to close my bank account because I'm a U.S. person. They don't like me. They don't want to deal with me. Well, the reason that is because there is a significant cost for these banks to do this reporting, to set up their systems to do the reporting, to commit time and resources to check the U.S. indicia on an annual basis. And so estimates have that for small banks, this roughly costs about $25,000 per year, whereas middle tier banks somewhere between $100,000 to $500,000, and then large banks about $1 million a year. Okay. The other big background item that that a lot of people have criticisms of the Foreign Account Tax Compliance Act. Okay, and so I'm going to go through kind of some general topics here. I've talked about the bank account closure, but let's talk about some other things that are also kind of happening in the background related to FATCA. So One thing is whether the cost of implementing FATCA, both by the IRS and all of these banks, is producing the ROI or the return on investment, and it's not. It's clearly not. I've given you the stats on that. It's supposed to raise 8.7 billion. So far, only about $14 million. So now naysayers would probably say, well, but at some point in time, it will pay off in the long run. If we look, for example, at the FBAR was signed into law in 1970. That's the Report of Foreign Bank Accounts, and really had no net effect on increasing revenue for many, many years. And now here in 2024, you're getting about $8 billion of FBAR penalties. And that's a lot. There's a lot of FBAR penalties floating around. So that's a longer term play out. But again, there should be an ROI based off of the bill that was passed, the HIRE Act, that came through within that 10-year period that has not. There has been flight of capital. So for example, a lot of folks, perhaps not wanting to work with IGA countries, have moved their accounts to non-IGA countries. There's been a huge spike in the increase of renunciation of US citizenship. This has caused in several cases, and Americans Abroad have documented this, that there's an organization called americansabroad.org that some countries it has strained their relationship with the United States to implement FATCA. We have what are called accidental Americans, so individuals that maybe were born in the United States, but then moved back to their home country when they were very young, didn't know that they were Americans until much later on in life, and then now having to go back and file and report all of this, even though they've never really taken advantage of the United States or any of the resources inside the United States. I talked about the lack of reciprocity. Again, the U.S. banks are not reporting, foreigners that have accounts in U.S. banks, which foreigners totally can have U.S. bank accounts, but they're not reporting those back to the home countries. The IRS capability of matching, and I'll go through again Form 8966 and Form 8938, but it's a lot of information that the IRS is receiving, and is it good information? And we'll talk about what's being reported on each of these forms and how does it match up, and what happens if you get a notice from the IRS saying, hey, something doesn't match. But the IRS ability to really say, it's one thing if you have a W-2 that you're getting for income, and you report something that's different from your W-2. That, I think, has a close matching probability there. Although I will say, and this is a topic for a later episode, but I will say for C-level individuals, especially CEOs, CFOs, COOs, especially if you have equity and all sorts of crazy employee benefits, I would say about 50% of all W-2s are probably wrong, or at least that's been my experience. But again, not to deviate off the topic here, but when it comes to the matching of the 8938, 8966, there's big questions there about the ability of the IRS to do that, especially with their decreased workforce and their lack of increased technology. It's created substantially increased complexity for U.S. tax returns ever since the 8938 was kind of put into play. Now we have heightened, there's all sorts of heightened reporting. It has increased visibility on things that probably should have been reported but never were, maybe Form 5471 for controlled foreign corporations, Form 8865 for foreign partnerships, Form 8858 for foreign disregarded entities, Forms 3520 and 3528 for foreign trusts. So those are things that again are creating a lot more complexity for taxpayers in general. In foreign countries, a lot of foreign countries have what are called data protection rights. There's GDPR, which is a big deal, which means that a lot of the personal identifiable information cannot leave that foreign country. So again, for the foreign financial institutions reporting this information back to the United States, there may be indications or issues with foreign law preventing them from doing so. There's an issue we have called duplicative reporting, and I'll talk extensively about this towards the end of this podcast. But in some cases, you're reporting the same information, or a lot of cases, reporting the same information on the Form 8938 that you're reporting on the FBAR. Now, the FBAR does not go to the IRS. It goes to the Financial Crimes Enforcement Network. So same family, the Department of Treasury, just a different place. And so does that reporting need to be done twice? The same thing could be said about the list of forms that I mentioned earlier related to foreign corporations and foreign partnerships, reporting it again on Form 8938. And then the massive amount of penalties, the civil and criminal penalties for non-reporting are quite high. So those are things that I want everyone to keep in mind. Okay, that's the background for FATCA. Now we're going to move on to the form 8966. And a lot of people probably have never seen this form. This isn't a form that is completed with a U.S. individual income tax return. This is a form that's completed by basically 3 different types of entities, okay? It's completed by a PFFI, a QI or withholding agent, or a direct reporting NFFE. Now, for purposes of this podcast, I'm only going to focus on PFFI, which is otherwise known as a participating foreign financial institution, okay? And a foreign financial institution is going to be one, or a PFFI is going to be one that is reporting under Model 1, which is the IGA that has the bank send the information to the foreign government and then over to the IRS, or under Model 2, okay? So that's going to be most banks are going to fall into PFFI. And if you look at the Form 8966, a PFFI basically has to complete the majority of the form. Now, if it's only, say, a U.S. individual, they only complete parts 1, 2, and 4, okay? But if you have, an equity interest or something that's different than just a normal bank account, maybe you have a foreign corporation in the mix, then part 3 also has to be completed. Okay, so what are these parts of the form? And again, I'm going to link the form. I'll link the instructions to the show notes. So if we look at Form 8966, in part 1, it's pretty simple. Who's the name? Who's the person that we're disclosing on? So for example, if I had an ownership interest in a foreign bank account, let's say I've got a UBS account in Zurich, then part 1 would be my name, my address in the United States, and my taxpayer identification number, otherwise known as my social security number, okay? Oh wait, I'm sorry, that's not me. The identification of the filer is going to be the bank. I'm sorry. It would be UBS, it'd be their name, their address, their bank. Then in part 2, it's the account holder information, and that's me, okay? So that's my name, my address, my social security number, all of that stuff, okay? And then on line 5 of part 2, okay, if the account holder is a business entity, okay, so let's just say that we're talking about an account, a bank account for a Swiss GmbH for which I'm the 100% owner. And so I'm listed as signator on the account or the account holder, right? So then my information is reported in part 2, my personal information, and or the information of the GmbH. And then I have to specify that GmbH is either going to be an owner documented FFI, a non-participating FFI, a passive NFFE, or a specified U.S. person. And that normally comes from the form W8BENE, capital E, okay? So the bank may request for that to be completed and sent to them so that they can properly determine how to complete part 2, line 5 of Form 8966. Okay, moving on. We get to part 3. And again, remember what I said earlier, Form 8966, in most cases, part 3 is going to be not completed, but in some cases it does. So part 3 is the owner information, okay? And in the owner information, once again, this would be my name, my address, my TIN. If it is a joint account or signature authority account, then I have to report the name of all the joint account holders that are U.S. persons and signature account authority of all the U.S. persons. So there could be multiple people that are reported in part 3 as the owner of the account. In part 4, this is where it gets a little interesting. You're reporting the account number, the account balance, the currency code, whether or not the account was closed during the year, and the types of income on lines 4A through 4D. Okay. Now, in the instructions, it tells you, it says, if the account is closed or transferred in its entirety during the calendar year, enter the amount of the value withdrawn or transferred, okay, as the account balance or value. And so that amount then has to be entered in for each joint account holder if it's a joint account. This is one of the few areas where if you have an account where it has multiple people on it, you're going to enter in the full value. You're not going to segregate out their interest in it because it's really impossible for the banks to determine what their interest is in the value of a joint bank account that's a deposit account or a custodian account. Now, we'll talk about this a little bit later, but when we get into other specified foreign financial assets that are reported, perhaps a foreign pension, a foreign trust, a foreign business entity, with that reporting, you're only reporting the specified interest of the person that you're reporting on, okay? And that makes a lot of sense. For example, let's say we have a pooled pension, right, that has maybe hundreds or thousands of pension holders inside one big pooled pension. You're not going to be reporting the full value of the pooled pension, right? You're only reporting the pension holder on there, okay? If you have a foreign trust and the beneficial owner is a 50% or more interest, you're not reporting the full value of the foreign trust because, again, you may never even get to know what the full value is with all the different other beneficial interests, but you do have to report the beneficial interest of the U.S. taxpayer, okay? And so forth and so forth. Let's take a look at Treasury Regulation 1.1471-5, and specifically -5B4, because I get this question a lot. What do they mean by account balance or value of the account? You know, when we talk about the F bar, you're reporting the maximum value that the account reached at any point during the year. When you're talking about the Form 8938, you're also talking about that amount. Now, the Form 8938 has some threshold testing where it takes a look at the maximum point and the year-end value. But what does it mean on the Form 8966 account value? What is the value that the bank will be reporting? And in this Treasury regulation, it talks about that issue. It talks about the joint account holder issue. And then it talks about aggregating up all the bank accounts. And basically what it says is it says the account balance, if you read the regulation, the account balance is the balance or value calculated by the financial institution for purposes of reporting to the account holder, okay? And what that basically means is that almost 10 times out of 10, they're going to report the year-end value of the account. So on the Form 8966, when you have the account balance, it's probably going to be the year-end balance. Now, there's an aggregation requirement, okay? So if you have multiple bank accounts and you have multiple interests at maybe even affiliated financial institutions, they're going to report all of those balances together. They're going to aggregate those. They're going to report all the accounts. They're going to report all the balances. And one thing to be aware of, if we look at the regulation that's directly before 1.1471-5, so -4, there's kind of this threshold that the Form 8966 operates under, meaning that they're not really looking at the aggregate balance or value for accounts which do not exceed $50,000 US. So if the accounts do not exceed $50,000 US, they're not even doing the reporting. So once the value goes over the 50,000, then they're doing the reporting, okay? So that's an exception for the reporting on Form 8966. There's also an upper limit, which is $1 million. And what happens with when an account aggregate balance exceeds $1 million? Well, there's enhanced screening and reporting that has to apply. And this is kind of a year-by-year test that the banks kind of have to go on. And so they call it an enhanced review of high value accounts once you exceed $100,000, okay? And so when that occurs, they have to do more than just, again, looking for that US indicia. There's a whole slew of subset of things that they would have to go look at. They maybe look you up online. They try to develop your profile a little bit more. They may request copies of contracts and documentation, and they probably will get legal counsel involved maybe. So if you have a high value account, and remember, this ties into what's currently happening here in 2024 with the IRS really trying to crack down on high net worth individuals. This is an area that is of enhanced scrutiny by the IRS at this point in time, okay? Going back to the -5 regulations, it does a really good job at providing examples of how the reporting works. So let's look at example 3 just to get a quick understanding. So it talks about you have a U.S. tax resident that has a custodial account with a year-end value of $35,000. They also have a joint custodial account with their non-resident alien sister that is also worth $35,000. Under the aggregation rules, this aggregates to over $50,000. And so both accounts must be reported on Form 8966 back to the IRS. Okay. If we move on to part 5 of the form, and this is the last part of the form, but yet it's the most dangerous part of the form, we have the pooled reporting types, okay? And this right here, the big one that you have to be careful with, if we look at line 1, it's got a series of 6 boxes. And the first box says recalcitrant account holders with U.S. indicia, okay? And what is a recalcitrant account holder? Well, it's someone that the FFI has reached out to. So the bank has reached out to a person they think that's a U.S. person. They've said, look, we think you're a U.S. person. Please tell us if you are. And there's been no response. They've said, look, we've reached out. We think you're a U.S. person. Please complete the Form W-9. No W-9. Or perhaps the account holder said, look, foreign law prevents, you shouldn't be disclosing this. I'm not a U.S. person. There's a waiver that has to be signed, but they have not signed the waiver. Or the account holder is an account holder with what we call a passive NFFE, so maybe a foreign trust or a foreign corporation, but they failed to provide the Form W-8BENE to the bank to verify that they're not a U.S. person, or that they are a U.S. person or not a U.S. person. So again, if they have U.S. indicia and they haven't followed through with that, they get classified as a recalcitrant account, and that typically is bad news. Once the IRS sees that, that could then trigger an immediate audit and request for more information for the taxpayer if they're able to match it up. So I think if we put together, and these are my concluding remarks on the Form 8966. I think if we put this together, if you have a high value account or accounts, so over $1 million, and you're classified as recalcitrant, I think that's probably the worst spot you can be in at this point in time with the matching of the Form 8966 to the Form 8938. I think if you're between the $50,000 to $1 million mark in recalcitrant account, that's kind of in the middle. And then I think if you're between 50,000 to 100,000 non-recalcitrant account, you've done everything properly, you're probably fine, but you want to be careful to do your reporting properly. I do remember between 2011 and 2016, I had a lot of clients that were, heavily trying to scrutinize the Form 8966 reporting. What's the foreign bank reporting? Trying to make that match up to their Form 8938, walking through every little tiny bit of the Form 8938, which we're going to talk about here in a minute, to make sure that every box was checked properly and everything was done, correctly, costing thousands of dollars of compliance. And I'm sure it's tough for them to know that really nothing was done with that. There was no matching really done with that during that time period, and that nothing kind of came out of it. So, but now those levels of efforts, I think you kind of want to get back to that, and you want to make sure, hey, what's the bank reporting? What's on the Form 8938? And make sure that you get all that to match up properly. And you definitely do not want to be classified as a recalcitrant account holder. So if a foreign bank is asking you to questions about whether or not you're a U.S. person, they're conducting their U.S. indicia test, make sure that you follow up with them. Do not respond. Make sure you complete that paperwork with them. Okay, let's move on now to the Form 8938. This will kind of conclude this masterclass today. So I talked earlier that the Form 8938 is completed by the U.S. taxpayer. It's attached to their individual 1040. It started in tax year 2011, so it was the first year it came into being. It is a separate filing requirement in addition to the FBAR. And it's based off of certain thresholds. So again, I just told you that generally for the Form 8966, they're really only looking at accounts solo or accounts in the aggregate over $50,000. But for reporting requirements, the Form 8938 is basically divided into individuals living inside the United States and individuals living outside the United States. So for example, if I'm single and I'm living inside the United States, then my foreign financial assets in the aggregate have to exceed $50,000 before $50,000 at year end or $75,000 during the calendar year before I'm required to report. Married filing joint, it's $100,000 or $150,000. Abroad, it then doubles. So if you're abroad, the year end is $200,000, and if you're married filing joint, the year end is $400,000. So I generally kind of keep in mind 50, 100, 200, 400. Those are the 4 data points I used for single, married, in the U.S. or abroad. Okay. The IRS also has a set of comparison charts about what is required to be filed on the 8938 versus the FBAR. And while these are nice charts, I don't think they always do a great job at explaining and sometimes do miss what's required to be filed on both. So I'd be very careful relying on that. That these are not the charts that they have put out on the website are not the Internal Revenue Code. They're not final regulations. You cannot rely upon them for preparing a tax return. They're at best persuasive guidance. So be very, very careful with that. The Form 8938 has 6 different parts to it, and they're all equally important, and they're all very nuanced, okay? And so if we look at the Form 8938, Part 1, basically, Parts 1, 2, and 3 are basically summaries, okay? So it's summarizing what is happening in the rest of the form. Part 1 is summarizing the deposit or custodial accounts, which I'll go into what those are here in a minute. So it wants to know what are the number of deposit accounts, what are the number of custodial accounts, what is the aggregate maximum value of those accounts, and then were any of those closed during the year, because again, that's going to match up to the Form 8966. Part 2 is going to talk about other foreign assets that are reported in Part 6. So custodial and deposit accounts are reported in Part 5. Other foreign assets, so for example, stock in a foreign corporation, foreign pensions, interest in a foreign partnership, beneficial interest in a foreign trust, those are all reported in Part 6. And those are then aggregated up in Part 2. Okay. And a lot of times what I see where tax preparers go wrong is in Part 2. For example, they'll report maybe 4 or 5 pensions. And so on line 10 in Part 2, it'll say 4 or 5. And then for some reason, their software doesn't aggregate up the value. And so line 11 is just blank. So there's no aggregate value for what's on there. And so obviously that's off. You got to have a number that flows into line 11 if you're reporting in Part 6. Or you should have a number, I should say that. Then in Part 3, this is where the rubber meets the road. This is where you got to be really, really careful, because any income that flows out of the accounts in Part 5 or Part 6 has to be detailed. What type of income is it? Is it interest, dividends, capital gains, pension distributions? And then you have to say exactly where that amount is reported on the Form 1040, or what schedule it gets reported on, or what form and line it gets reported on. So it all has to tie out. And you'll see later, we'll talk about this, that if you don't do that reporting properly, it actually keeps the statute of limitations open for the income for up to 6 years. And there's also significant penalties the IRS could assess for not reporting the income from a foreign account in Part 5 or Part 6. Now, in Part 4, this is where the IRS is trying to be a little bit more helpful. They've added in Part 4 so that you don't have to do duplicative reporting. But I'll talk about why I think this section is a no-go here in a minute. But in Part 4, for example, if I'm reporting a foreign grantor trust on Forms 3520 and 3520A, I'm going to say yes on line, I'm going to put 1 on line 15 and 1 on line 16. And then I separately do not need to put the value of the foreign grantor trust into Part 6 because there's duplicative reporting exceptions. I've already reported the value on Forms 3520 and Forms 3520A. Okay. Moving on, I said I was going to define a deposit account and a custodial account. Well, a deposit account, because I get this question all the time, what's the difference? What's the difference between a custodial account and a deposit account? Well, a deposit account is going to be a checking account, a savings account, a certificate of deposit, a passbook, a certificate of indebtedness. Those are generally going to be a deposit account, okay? Whereas a custodial account, and again, I'll link the regulations that define all of these, they're going to be some kind of financial instrument, contract, or investment, okay? So in some cases, or the best case I can put this on is that if you had a mutual fund, right, that had its own account number, then that would be listed as a custodial account, a foreign mutual fund. Now, that's also a PFIC, and so there's a question there of duplicative reporting. That's reported on Form 8621, but separately, that's also a custodial account. Okay. And in part 5, line 20A and 20B, that's where you'll make your difference between deposit account versus custodial account. On line 21, you'll indicate the account number. On line 22, you'll tell the IRS whether you open the account, close the account, or own it jointly with the spouse. You also have to indicate if there's no tax item reported in part 3. Remember, I said in part 3 that it talks about the income that flows out of the accounts in part 5 and part 6. Well, on question 22, line D, that's basically saying, look, IRS, I've got a bank account. It's a checking account, no income, no interest income, nothing's coming out of it. Don't worry. Don't worry about trying to match up income. On line 23, you report the maximum value of the account. On line 24, you have to give the currency conversion information, line 24 and 25. That's very, very important to kind of detail what you use, especially if the source is not the Treasury Department's year-end rates. And then lastly, lines 26A through 28, you're going to detail the financial institution. So this reporting is going to be kind of the exact opposite reporting of the Form 8966, and this is where they try to match everything up. Now, as you can see, there's more reporting here than the Form 8966 because you're telling the IRS whether you open the account, and the Form 8966 does nothing about opening an account. Also, you're reporting the maximum value of the account on line 23, not the year-end value. So again, if I get an 8966 and my year-end value is different than my maximum value, well, how does the IRS reconcile that? That's a big question that I have. That's a lot of big questions that a lot of people have. Moving on to part 6 of the form. This is where it gets a little bit more tricky. This is part 6 is you're reporting foreign pensions, corporate stock, interest in a partnership, an estate. If you're beneficial, you have a beneficial interest in a foreign estate. So let's say you have, we always talk about that rich foreign relative, that rich non-U.S. uncle that dies and leaves you all their money. Well, you know, a lot of times a foreign estate takes several years to wind up, and while you have that beneficial interest in that foreign estate, you do have to report it on Form 8938 Part 6. So quickly, we'll go through part 6. So line 29, you got to describe what the asset is because this is not a custodial or deposit account. In line 30, you have to provide the identifying number or some other designation. Now, one trick to the trade here is that if there is no identifying number, so for example, you've got a foreign beneficial interest in a foreign estate, there's no real identifying number with that. I always tell my clients, let's put in your U.S. Social Security number or your TIN and use that in lieu of the identifying number as the other designation. Lines 31A, you have to describe or tell the date in which the asset was acquired. 31B, you have to tell the date in which the asset was disposed. 31C is if it's owned jointly with a spouse. 31D is if there's no tax item reported in Part 3. Then this is where we get a little tricky at. Line 32A through E, it gives ranges for the value of the asset. And then if it's over $200,000 of value, then you actually have to give the amount. However, in the tax software, you should still be able to give a very specific amount. And that should then aggregate up to Part 2. Now, I will say that some things, like, for example, a foreign pension plan that's a defined benefit plan has no ascertainable value. The value of that is then 0, for example, and you would click line 32A. But you also want to enter in 0 into the totals there so it aggregates up properly. Line 33 is, and 34 goes back to the foreign currency conversion. And then here's where I see a lot of CPAs or tax preparers get it wrong. Lines 35 and 36. And you got to read. I always tell folks, read real closely what it says. So line 35 says, if the asset reported is stock of a foreign entity or interest in a foreign entity, then you complete line 35. And then line 36 says, if it's not stock, then you complete line 36. So for example, most foreign pensions are not going to be stock in a foreign entity or interest in a foreign entity. Almost 9 times out of 10, that's going to be the case. So for a foreign pension, you're never going to complete, or rarely would you ever complete, lines 35A through E. A lot of times those are blank, and then you drop down and you complete line 36A through E. And again, then it gets a little kind of tricky, right? Okay, so for example, we get into line 36. Name of the issuer or counterparty. Is it an issuer? Is it a counterparty? That one you kind of got to do some analysis on to figure out. And then type of issuer, counterparty, individual, partnership, corporation, trust, estate. Is it a U.S. person, a foreign person? So really interesting. And this is where it gets really tricky to do the proper reporting in part 6. Okay, so why is this all, where am I heading to, Mish? Why is this all important? Why are you telling me about this? Well, the IRS has a campaign. They've got a campaign going on right now where they're doing data filtering and analysis on the Form 8966, okay? The form is then matched to the Form 8938. The IRS is identifying variances in reported data between the Forms 8966 and 8938. And they're going to be addressing potential non-compliance via correspondence and penalty notices, okay? And what does non-compliance mean? Well, non-compliance generally means a failure to report a foreign account. So for example, if the Form 8966 is reporting 4 accounts, but your 8938 is reporting 3 accounts, that could trigger a non-compliance notice. Or if there's a mismatch of data being reported, right? So, if the year-end value is $1 million on the 8966, but your highest value that you're showing for the same account is only $50,000, that may trigger some kind of correspondence or notice from the IRS, okay? The IRS does want to, did kind of give some examples of things to think about. So first off, if a taxpayer is not required to file the Form 1040, and again, there's a really good article that just came out about this, about, in some cases we see people that just don't make any money at all, or maybe make less than the standard deduction. And the prevailing, thought process there is you don't need to file your 1040, right? Now, there's some comments made in the article I read recently that said, well, perhaps you should still file just to be safe, because if you don't file, then it never starts the statute of limitations. So there's a whole argument there. But in cases where there's no filing requirement and the 8966 is filed, there's no 8938 that they're going to have to match against. So that could create an issue. So again, that may lead me to tell a taxpayer that normally doesn't have a filing requirement, we probably should file, and we probably should do the 8938 just to be safe. The second thing, which I talked about earlier, which is the duplicative reporting. So for example, if I'm filing forms 3520, 3520A for foreign grantor trusts, 5471 for a foreign corp, 8621 for a PFIC, or 8865 for a foreign partnership, I normally will check specified foreign financial asset on that form. And then in part 4, I'll fill out the exception reporting. However, the IRS is saying, well, look, in some cases, we're getting these 8966s from the passive NFFEs, and there's nothing on the 8938 that we're able to match up against. And our systems don't really go check the 3520, 3528, 5471. So, that could create a compliance notice that then you'd have to deal with. So then the question is, well, should we just do duplicative reporting? Would I then just report the value of the foreign grantor trust, say, in addition to doing it on the 3520, 3528? Should I just go ahead and report that on the 8938 Part 6? There wasn't really a good response from the IRS on this. I don't think they really wanted to say yes or no, but I think this is an area that I would tell all people, maybe over-report here. Not only report it on the International Informational Report, but also report it extra on Form 8938 Part 6. So something to keep in mind. Another example that was brought up was that if an FFI files 2 forms 8966 for the same account, one for each spouse, but there's only one filed on the Form 8938. So for example, let's say we have a joint account. Well, the 8966 may have over-reported, and so now you see 2 times the actual value of an account, whereas it should only be 1. So that could be an issue. There's another example of an FFI filing 3 separate Forms 8966 for 3 different account holders on the same account. So now it's 3 times the rate. Different currency conversion rates can be used. So for example, if you look at the 8966 reporting, they're doing certain reporting under spot rates and regulation 988 rates. So that might be different from the year-end treasury rates, which then could cause a value difference, okay? Some countries, they use commas that are different from decimal points, and that also can sometimes create issues. So for example, they brought up an issue where, the 8966 said the value of an account was $16.2 billion, where in the end it was only $16.2 million. And then Sub-accounts are always a problem. So I'm thinking about, for example, FDs in India. So FDs in India are basically certificates of deposit that have multiple sub-accounts, and rolling those all up to reflect properly on the 8966 versus the 8938 can always create problems. Because again, they're going to report, all of those sub-accounts. They're going to aggregate report all of those up, and then matching that over to how those are reported on the 8938. For example, if you listed those as custodial accounts when in fact they're deposit accounts, now you've got a problem. Couple other things to note for guidance purposes. So if you do get a notice on Form 8938, that's not a $10,000 initial penalty notice. It does not disqualify you from streamline filing. Okay, and the IRS is very specific about this. You can still cure any issues you may have by using the streamline procedures, but you generally want to make a request with the IRS, with the person that sent you the notice, to make sure that they know that you're going to go do that, and that's going to be something that's going to be a way that you're going to cure whatever issue that you have there, and so that also avoids the $10,000 civil penalty. Okay. Couple other things that I want to talk about, and we're going to conclude here shortly, but the statute of limitations. So if you fail to file the FBAR, the tax return remains open indefinitely until you actually file the 8938, and then the statute of limitations for assessment on the tax return for the 8938 closes 3 years after you file. And so according to the language, the statute remains open for all or part of the income tax return, which is a really interesting thing there. So for example, if I've got a taxpayer that comes to me today, and I'm speaking to you on September 12th, 2024, and they say, Mish, I've never filed the 8938, but I probably should have since 2011. That's an interesting case because, well, first off, I'm probably going to try to cure that through streamlined filing. So maybe I'm doing 8938s for just 21 through 23. But what about the 8938s for 2011 through 2020? Those just remain open indefinitely forever. I mean, the streamline program kind of says that they're not going to do anything about those, but still it's there. And then let's just say I had the hyper aggressive, very worried client that says, no, I really want to file amended returns all the way back to 2011. Well, a lot of tax softwares, my tax software at the moment probably doesn't go back, probably goes back as far as maybe 2015 to do a tax return, through the tax software. Outside of that, I got to, manually download the forms off the IRS website and then manually, do the tax reporting by hand. And more so, talking about 2011 through 2017, that's pre-TCJA law, which a lot of, then you got to figure out who knows that, who remembers all the pre-TCJA rules, and properly make sure the tax return is done correctly there. So there are a lot of issues floating around with how to deal with 8938. Do you go all the way back to 2011? Do you do streamlined filing for only 3 years? Do you follow, IRS, was it P-155, which is they generally want 6 years to be in full compliance. So there's a couple different ways to slice the 8938 compliance. And then for the last part of the section related to the 8938, if you fail to emit more than $5,000, any tax you owe increases the statute of limitations for assessment to 6 years. So normally it's 3 years for the statute of limitations for assessment. But for example, if you don't complete part 3 on the Form 8938 and you don't include the income on the tax return, then you're looking at a 6-year statute of limitation for assessment instead of 3 years. Okay, and the very, very last topic that I want to talk about today are the states within the United States in Form 8938. And yes, you're thinking, well, what do you mean? The FATCA is federal, it only goes with the federal tax return. That is not always the case. So for example, in California basically has conformed to FATCA, it's conformed to the HIRE Act. And California requires that if you file the Form 8938 at the federal level, you have to attach the Form 8938 to your California tax return. Same would go with IRS Form 5471, IRS Form 5472. But specifically for the 8938, if you don't file that with the state of California, it's a $10,000 penalty that the California Franchise Tax Board can assess. So be very careful. Make sure to check your state with the international informational reports. Some states may have conformed and may require that you also file for an international informational report that carries a civil penalty with the state as well. And with that, that is the basics of FATCA 8966, 8938. Hopefully for those folks that have issues related to this reporting, you've learned a lot more today about, the nuts and bolts about why that reporting is there, how to do that reporting properly, and what to do if you receive a notice or have an issue related to that reporting. Thank you.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.